My friends, the most important question in all of investing is this. What is it worth? Not what does it cost? Not what did it sell for yesterday? Not what your neighbor thinks it might sell for tomorrow. But what is it actually worth? What is the intrinsic value of the business you're considering buying a piece of? This is the question that separates investors from speculators, the question that professionals ask but amateurs ignore, the question that when answered correctly leads to wealth, and when ignored leads to ruin. Today I'm going to teach you how to value a stock the way a professional analyst does, not with complicated mathematics that obscure rather than illuminate, not with crystal ball predictions about the distant future, but with sound, time-tested methods that you can apply to any business, in any industry, at any time. I've spent my entire career analyzing securities. I've valued thousands of companies. I've taught this method to countless students, many of whom became successful investors in their own right. And I can tell you with absolute certainty that anyone of reasonable intelligence can learn to value stocks properly. It requires no special genius. It requires only clear thinking, basic arithmetic, and the discipline to stick to sound principles. By the end of this discussion, you'll understand the fundamental approaches to valuation. You'll know how to apply them practically, and most importantly, you'll know how to think about value in a way that will serve you for a lifetime of investing. Let's begin. Before we discuss techniques, we must establish the fundamental principle that underlies all valuation. A stock is worth the present value of all future cash flows it will generate for its owners. This sounds complex, but it's actually simple. When you buy a share of stock, you're buying the right to receive your proportionate share of everything that company earns, from today until the end of time. The value of that right depends on two things: how much the company will earn, and when you'll receive those earnings. Think of it this way. Suppose I offer to give you $100. That $100 is worth $100, obviously. But suppose I offer to give you $100 10 years from now. That's worth less, because you have to wait, and because there's some uncertainty whether you'll actually receive it. The further in the future the payment, the less it's worth today. This is the time value of money, and it's fundamental to all valuation. $1 today is worth more than $1 tomorrow. Now here's where it gets interesting. For most businesses, we cannot possibly know what they'll earn 20 or 30 years from now. The future is too uncertain. Our predictions would be little better than guesses. And valuation based on guesses is not valuation at all. It's speculation. So the practical investor must take a different approach. Rather than trying to predict the distant future with false precision, we focus on what we can know with reasonable confidence: the company's current financial position, its demonstrated earning power over recent years, and the stability and sustainability of those earnings. From these knowable facts, we derive conservative estimates of value. We accept that we cannot be perfectly accurate. We embrace uncertainty by demanding a margin of safety, and we proceed with humility about the limits of our knowledge. This is the philosophical foundation. Now let's discuss the practical methods. The first method of valuation, and in many ways the most conservative, is asset-based valuation. This asks a simple question. If we liquidated this company today, selling all its assets and paying all its debts, what would shareholders receive? This is also called book value, or net asset value. You take everything the company owns: cash, inventory, equipment, real estate, accounts receivable, and subtract everything it owes: loans, accounts payable, bonds, and other obligations. What remains belongs to the shareholders. Now I want to be very clear about something. Book value is not market value. The balance sheet typically records assets at historical cost, not current market prices. A building purchased 50 years ago for $100,000 might be worth millions today, but it still sits on the books at $100,000. Similarly, some assets recorded at cost might be worth far less today: obsolete inventory, outdated equipment, uncollectible receivables. The skilled analyst adjusts for these discrepancies. He asks, what would these assets actually fetch in a sale? What are the hidden liabilities not fully reflected on the balance sheet? What is the realistic liquidation value? Let me give you a practical example. In the years after the 1929 crash, I found many companies selling for less than their net current assets alone. That is, cash plus accounts receivable plus inventory minus all liabilities, including long-term debt. These companies had factories, equipment, and real estate that weren't even counted, yet the stock sold for less than the liquid assets. This is what I call buying stocks at a discount to their net current asset value. It's the most conservative form of asset-based investing because you're getting everything else, the business itself, for free. If the company simply liquidated and distributed the cash, you'd make a profit even if all the other assets were worthless. But asset-based valuation has its limitations. For many modern businesses, particularly service businesses or technology companies, assets aren't the main source of value. A consulting firm might have few physical assets, but generate enormous profits. A software company's real value lies in its intellectual property and earning power, not in its office furniture. This brings us to the second method of valuation, earnings-based valuation, 9 a.m. to 12:30 p.m. The second method, and the one most useful for profitable going concerns, is earnings-based valuation. This asks, what are the normal earning power of this business, and what multiple of those earnings should I pay? Let's start with determining normal earning power. You don't simply look at last year's earnings. One year can be abnormal, unusually good or unusually bad. Instead, you examine 5 to 10 years of earnings history. You look for the average, but you also look for stability and trend. A company that earns steadily around $2 million per year has demonstrated normal earning power of $2 million. A company whose earnings bounce wildly between losses and profits has uncertain earning power. You might estimate conservatively or avoid it altogether. A company whose earnings have grown consistently from $1 million to $3 million over 10 years has both demonstrated earning power and growth prospects. Once you've established normal earning power, you must decide what multiple to pay. This is where judgment enters the picture, and it's where most people go wrong. They pay too much. The multiple you should pay depends on several factors. First, the quality and stability of earnings. A utility company with steady, regulated earnings might justify a higher multiple than a cyclical manufacturer whose earnings fluctuate with the economy. Second, the company's financial strength. A debt-free company with a strong balance sheet deserves a higher multiple than a leveraged company vulnerable to downturns. Third, the company's growth prospects. A company growing steadily might justify a higher multiple than a stagnant one. But here's my rule of thumb, and I urge you to write this down. For the typical industrial company with average prospects, a multiple of 10 to 15 times normal earnings is reasonable. For exceptionally stable, high-quality businesses, you might go to 20 times earnings. For cyclical, risky, or troubled businesses, you should demand a lower multiple, perhaps 7 to 10 times earnings. Let me illustrate. Suppose you're analyzing a manufacturing company. You examine 10 years of earnings and find they've averaged $3 per share, ranging from a low of $2.50 to a high of $3.50. This is reasonably stable earning power of $3 per share. If this is an average quality business with moderate debt and average growth prospects, I'd estimate its value at roughly $30 to $40 per share, 10 to 13 times normal earnings. If the stock trades at $25, it's potentially attractive. If it trades at $50, it's fully valued or overvalued. This is practical valuation. No complex formulas. No predictions about earnings 15 years from now. Just sound analysis of demonstrated earning power and a reasonable multiple based on quality and stability. The third method is dividend-based valuation, which is particularly useful for mature, stable companies that pay substantial dividends. A dividend is not merely a distribution of cash, it's proof of earning power. A company that pays a 3% dividend year after year, through good times and bad, is demonstrating that its earning power is real and sustainable. The dividend is money in your hand, not just a number on an accounting statement. For valuing dividend-paying stocks, I recommend a straightforward approach. Calculate the dividend yield, the annual dividend divided by the stock price, and compare it to the yields available on high-grade bonds. Suppose high-grade corporate bonds yield 4%. A stable dividend-paying stock should offer a higher yield to compensate for the additional risk of stock ownership. Perhaps you require 5 to 6%. If a company pays a $3 annual dividend and you require a 6% yield, you should pay no more than $50 per share. But dividends are more than just yield. They're also a discipline on management. A company committed to paying dividends cannot squander all its earnings on foolish acquisitions or empire building. It must retain only what it can profitably reinvest and distribute the rest to owners. This is healthy corporate governance. I'll share an observation from my decades of experience. Companies with long histories of stable or growing dividends tend to be better managed, more shareholder-friendly, and safer investments than companies that retain all earnings with vague promises of future growth. The dividend is tangible. Future growth is often illusory. Now, I'm not suggesting you invest only in dividend-paying stocks. Young, growing companies often should reinvest all their earnings rather than pay dividends. But for mature companies in stable industries, a substantial dividend yield is both a source of return and a mark of quality. Combine dividend yield with earnings analysis. If a company earns $5 per share and pays $3 in dividends, it's paying out 60% of earnings. This is sustainable. If it earns $2 and pays $3, it's paying out more than it earns, a warning sign that the dividend may be cut. Dividend-based valuation is simple, conservative, and particularly suited to the defensive investor seeking steady income and capital preservation. Section 5. Comparative Valuation, 15 to 1730. The fourth method is comparative valuation, where you compare a company's valuation metrics to those of similar companies or to the overall market. This is where investors often go astray, so listen carefully. Comparative valuation is useful, but only if you're comparing sound values to sound values. If the entire market is overvalued, comparing one overpriced stock to other overpriced stocks tells you nothing useful. That said, when used judiciously, comparative analysis has merit. You calculate key ratios, price to earnings, price to book, dividend yield, and compare them across similar companies in the same industry. For example, suppose you're analyzing 3 electric utility companies. Company A trades at 12 times earnings with a 4% dividend yield. Company B trades at 15 times earnings with a 3% yield. Company C trades at 9 times earnings with a 5% yield. If all 3 have similar financial strength and growth prospects, Company C appears relatively undervalued, while Company B appears relatively overvalued. This doesn't tell you the absolute value, but it tells you which offers better relative value. You can also compare a company to its own historical valuation. If a company typically trades at 12 to 15 times earnings and currently trades at 8 times earnings, this suggests possible undervaluation, provided the business fundamentals haven't deteriorated. But here's the critical point. Never use comparative valuation alone. Always anchor it to absolute valuation based on assets, earnings, or dividends. The fact that a stock is cheaper than its peers means nothing if both are overvalued. The fact that a stock is cheaper than its historical average means nothing if the business has permanently deteriorated. Use comparative analysis to identify relative value among a group of absolutely sound values. Don't use it to rationalize paying high prices because everything else is even more expensive. Now let me show you how to synthesize these methods into a practical valuation framework. When analyzing any stock, I follow this process. First, I examine the balance sheet and calculate asset value. What's the book value per share? What's the net current asset value? This gives me a floor, the ultimate downside protection if everything goes wrong. Second, I analyze earnings. What has the company earned on average over the past 7 to 10 years? How stable are those earnings? What multiple of earnings seems reasonable given the company's quality, stability, and prospects? This gives me an estimate of value based on the business as a going concern. Third, I look at dividends. What's the yield? Is the dividend safe and growing? How does the yield compare to bonds and to historical norms? This provides another perspective on value, particularly for defensive investors. Fourth, I consider comparative metrics. How does this company's valuation compare to competitors and to historical averages? This helps me understand whether my absolute valuation is reasonable. Then, and this is crucial, I look for convergence. If all four methods suggest the stock is undervalued, I have strong conviction. If asset value suggests one thing, earnings suggest another, and dividends suggest a third, I proceed with caution or pass entirely. Let me give you a complete example. Suppose I'm analyzing a chemical manufacturer. Book value is $40 per share, with net current assets of $30 per share after all liabilities. The company has earned an average of $4 per share over 10 years, ranging from $3 to $5. It pays a $2.50 dividend. The stock currently trades at $35. Asset-based valuation suggests a floor around $30 in liquidation, with book value of $40. Earnings-based valuation, using a multiple of 10 times for this cyclical industry, suggests $40. Dividend-based valuation, with a $2.50 dividend, gives a 7% yield at $35, attractive compared to 4% bonds. Comparative analysis shows this company trading at 9 times earnings, while competitors trade at 12 times earnings. Conclusion: the stock appears modestly undervalued across all methods. At $35, I'm buying assets worth $40, earning power worth $40, and getting a 7% dividend yield. I have a margin of safety. This is a sound investment. This is how professionals think about valuation: multiple perspectives, conservative estimates, convergent evidence, margin of safety. My friends, you now understand the fundamental methods of stock valuation: asset-based analysis for downside protection, earnings-based analysis for going concern value, dividend-based analysis for income and discipline, comparative analysis for relative positioning. But let me leave you with this thought: the numbers are important, but they're not everything. Behind every valuation is a business, real people making real products or providing real services to real customers. The numbers are simply a way of quantifying the value of that business activity. Never lose sight of the business underneath the stock. Ask yourself, do I understand what this company does? Is it providing real value to customers? Does it have sustainable competitive advantages? Is management honest and competent? These qualitative factors matter enormously. A precisely calculated value for a business you don't understand is worthless. A roughly estimated value for a business you understand deeply is invaluable. Master these valuation techniques, but also cultivate business judgment. Study companies. Read annual reports. Think like an owner, not a trader. Over time, you'll develop an intuition for value that complements your analytical skills. Remember always, the goal is not to calculate value to the penny. The goal is to determine whether a stock offers a sufficient margin of safety at its current price. If it does, invest. If it doesn't, wait. The market will eventually offer you opportunities if you're patient and prepared. Value what you buy, and buy only what's valuable. This simple principle, applied consistently over time, is the foundation of successful investing. Now go forth and analyze. You have the tools. Use them wisely.